Welcome to the deep dive. Today, we're tackling a really fundamental question in finance. What truly determines what a company is worth?
Right.
We're diving into equity valuation. It's crucial for theory, but also for actual investing decisions.
Absolutely. And you probably know the traditional ways like figuring out future dividends or maybe a company's residual income.
Yeah, and then discounting all that back to today's value.
Exactly. It's all focused on the future, what the company might generate, the demand side, really.
Right, but doing that in practice, it feels a bit like predicting the weather years out, doesn't it?
Yeah, that's a good way to put it.
Yeah.
Forecasting earnings accurately, pinning down the exact right discount rate.
hmm
It's tough.
It really is. I always think of that John Cochrane quote suggesting the field almost shifted from asset pricing to just explaining asset expected returning.
Focusing on things like market-to-book ratios.
Yeah, and it makes you wonder if we're sometimes just, looking at the price tag without fully getting why it's priced that way.
That really sets us up perfectly for today's discussion. Because instead of focusing only on that demand side, what investors expect, we're flipping it.
Okay.
We're going to explore uh, a supply approach to valuation.
A supply approach. Okay,
They-
intriguing. What's the core idea there?
The basic idea is this. We can figure out the value of a company's assets by watching how its managers actually invest in those assets.
How they invest.
Yeah, the thinking is managers will keep putting money into new assets only as long as the expected benefit, the payoff from that extra asset, is more than what it costs to acquire or build it.
So instead of predicting future profits way out there, we're looking at the actual tangible costs companies are dealing with now to grow.
Precisely. The cost of supplying those assets through investment. That cost structure can reveal a lot about the underlying value, the price of those assets.
This is getting interesting. So for someone listening, trying to figure out if a stock is, say, fairly valued, what's the main advantage here? What's the potential shortcut?
Well, the really compelling part, I think, is that this supply view leans heavily on current observable stuff.
Like what?
Specifically, how much a company is investing right now compared to the capital it already has. It's often called the investment to capital ratio.
So we don't get bogged down in those super long-term forecasts.
Yeah.
Or trying to nail the perfect discount rate.
Exactly. Those are the two big hurdles with traditional methods, and this approach offers a way around them, potentially.
Okay, a different path to valuation using data we can actually see. Sounds promising. So what's our mission for this deep dive then?
Our mission today is to really dig into this supply approach. We're using a key study by Bello, Zhu, and Zhang from 2013 as our guide. We'll explore the theory behind it, something called Q theory.
Okay.
We'll look at the practical advantages, the evidence they found, and ultimately what this whole perspective might teach us about thinking about company value.
All right, let's dive in. You mentioned Q theory. What exactly is that? How does it form the foundation here?
So Q theory, at its core, it's about that investment decision I mentioned. Managers invest until the marginal benefit equals the marginal cost.
Right.
That marginal benefit is often called marginal Q. Think of it as the present value of all the future cash flow you'd get from adding just one more unit of capital, one more machine, say.
Okay, marginal Q sounds important, but a bit abstract. How does it connect to something we might actually see or calculate, like Tobin's Q?
Great question. Tobin's Q is something we can calculate. It's simply the market value of a company divided by the replacement cost of its assets, basically. Market value over book value of capital.
Okay, so what the market thinks it's worth versus what's on the books.
Exactly. Now, under certain specific assumptions, often called the Hayashi conditions, which basically assume things scale up smoothly, constant returns to scale, there's a direct link. Tobin's Q should actually equal marginal Q.
So Tobin's Q, this observable ratio, can potentially tell us something about that unobservable future benefit, marginal Q.
That's the crucial link, yes. It suggests we can infer something about the value generated by investment by looking at this market-to-book ratio.
So the supply approach uses this idea. It tries to figure out marginal Q, and thus the asset value, by looking at how much companies are actually investing.
Precisely. It models the cost side. It specifies what's called a capital adjustment technology.
Okay, fancy term. What does that mean practically?
Think of it like a formula describing how costly it is for a company to invest. It takes inputs like the investment rate and tells you the cost. By observing the investment rate and knowing this cost formula, we can infer the marginal cost of investment.
And because managers should invest until marginal cost equals marginal Q.
Bingo. We can estimate marginal Q and therefore the underlying asset value from the investment data and the assumed cost structure.
But surely it's not just a simple cost formula. The real world's messy, right? What complexities does their model account for?
Oh, absolutely. The Bellow, Zhu, and Zhang model is pretty sophisticated on this front.
Right.
It incorporates things like corporate taxes, leverage how much debt a company uses.
Mm-hmm.
It accounts for capital depreciation, the fact that assets wear out, and even allows for that depreciation rate to change over time. And importantly, it allows for nonlinear marginal costs of investment,
Non-linear, meaning.
meaning the cost of adding the next unit of capital might go up faster and faster the more you're already investing. Think about trying to rapidly expand a factory. The first few machines might be easy, but pushing beyond that could get much more expensive, needing new buildings, more complex logistics, etc.
Okay, that makes sense. So they build this complex model reflecting these costs. How do they test if it actually works, if it predicts valuations well?
They use a statistical technique called the Generalized Method of Moments, or GMM. You can think of GMM as trying to make the model's predictions match certain features of the real-world data as closely as possible on average. In this case, they test if the model can match the average Tobin's Q observed for different groups of firms,
And they group firms based on.
based on their actual observed Tobin's Q. They typically sort firms into 10 groups, deciles, from lowest Q to highest Q. The goal is to see if the model, using only investment data and its cost parameters, can replicate the level of Tobin's Q seen in each of these deciles.
So if the model captures the real economics, its predicted Q should line up with the actual Q across these different groups.
That's the idea. It's a test of whether the model explains the level of valuation.
Okay, that lays the groundwork nicely. Let's circle back to the advantages. You said the supply approach might be better practically than the traditional demand-side methods. Can you reiterate why?
Sure. The biggest advantage, as we touched on, is data availability. It primarily relies on current investment to capital. That's data you can generally get.
Right, observable data, not forecasts.
Exactly. You avoid needing that crystal ball for future earnings or cash flows years down the line. We all know how inaccurate those long-term predictions can often be.
Definitely. And what about the discount rate? That's always the other big challenge, isn't it? Picking the right rate.
It absolutely is. And this supply approach kind of sidesteps that whole issue. Because it directly links Tobin's Q to the costs of investment, it doesn't need you to take an explicit stand on what the correct discount rate is.
Which is good because estimating those discount rates, it's not exactly precise science, is it?
Not at all. Researchers like Fama and French, Penman, Lundholm, and Sloan, they've all pointed out how imprecise and sensitive those discount rate estimates can be. Small changes in your assumptions can lead to wildly different valuations.
So if it's not relying on forecasts or discount rates, what is it relying on, these parameters in the cost function?
Yes, things like how sensitive investment is to changes in Q, or how quickly that marginal cost of investment ramps up that nonlinearity we talked about.
And why might those be more reliable?
The argument, drawing on ideas from economists like Robert Lucas, is that these parameters are more related to the firm's actual technology of production and investment. They're potentially more stable, more structural, compared to something like a market risk premium, which can swing around with investor sentiment or policy changes.
So it's grounded more in the physical realities of the business, less in market psychology.
That's the hope, yes. It offers a valuation perspective rooted in observable business actions and technological constraints.
That's a compelling argument. Okay, so the theory sounds good. The potential advantages are clear. How well does it actually work? What did Bello, Su, and Zhang find when they tested it against the data?
Well, this is where it gets quite striking. Their central finding relates to the valuation spread. That's the difference in Tobin's Q between the highest Q firms and the lowest Q firms.
Okay, the gap between the growth stocks and value stocks, roughly speaking by Q.
Sort of, yes. The model, based purely on investment costs, predicted a valuation spread of 4.45.
And the actual spread in the market data they looked at from 1963 to 2011.
The actual observed spread was 4.50.
Wow. Okay, 4.45 predicted versus 4.50 actual. That is remarkably close.
It's incredibly close. The model error there is tiny. It suggests that a huge chunk of that observed valuation difference across firms might actually be explained by differences in their investment costs and opportunities.
That's pretty powerful. What about across the board, not just the extremes, but all 10 deciles? How well did the model fit there?
Also very well. The average absolute error, so the average difference between the predicted Q and the actual Q across all 10 groups, was just 0.07.
Zero point zero 0.07 compared to an average Q. How big is that?
It's small, about 4.5% of the average Tobin's Q across all the deciles. So the model wasn't just getting the spread right, it was getting the level of Q pretty accurate for most groups.
And did they visualize this?
They did. They have a chart, figure 1 in their paper, which plots the predicted average Q against the actual average Q for each decile. And honestly, it looks almost like a perfect 35-degree line. The fit looks visually very strong.
Okay, so statistically and visually, it seems to match the average valuation levels quite well. But Tobin's Q itself uses market prices, right? Market prices can be noisy, maybe even reflect mispricing sometimes. Does that cause problems?
That's a fair point. Measurement error in Q is definitely a potential issue. Market values fluctuate for all sorts of reasons. They did look at how their predicted Q correlated with actual Q over time, both levels and changes.
Yeah.
The correlations weren't perfect, which isn't surprising given market noise. But their main test, focusing on matching the average Q across these portfolios over long periods, that helps. Random noise or temporary mispricings are more likely to average out over time and across firms within a decile.
So focusing on the first moment, the average, helps mitigate those measurement error concerns.
Exactly. It gives a clearer picture of the underlying relationship between investment costs and average valuation levels.
Okay, the core results seem strong, but did they just test it on the broad market? Or did they, stress test it? What about firms that might not fit the standard model well, like ones that struggle to get financing?
Oh, they definitely pushed it further. They ran a whole series of robustness checks and extensions. They sliced the data in different ways.
Like how?
They looked at subsamples based on firm characteristics. For example, they used the SA index to identify firms that might be more financially constrained. They also looked at firms with high idiosyncratic volatility, different levels of cash flow, or different past investment behavior.
And how did the model do in those specific cases? Still hold up?
Generally, yes. It performed reasonably well across most of these subsamples, still matching the valuation levels fairly closely.
But any cracks appear?
There were some instances, particularly in some of these subsamples, where the models seemed to imply higher costs of adjusting capital than may be expected. This could hint at some model specification issues, maybe needing to account more directly for financial frictions or other factors in those specific cases.
Okay, so mostly good, but maybe some room for refinement. You also mentioned they did some joint estimation. What was that about? Estimating valuation alongside something else.
Right. One important test was jointly estimating the valuation moment, matching Tobin's Q, along with an expected return moment.
So trying to explain both valuation levels and stock returns simultaneously.
Exactly. This brought in a new parameter related to capital share of output. They wanted to see if the model could generate reasonable stock return predictions while still matching Tobin's Q.
And could it? How did the return predictions look?
The return predictions weren't perfect when compared to standard benchmarks like Carhart alphas, but they weren't terrible either. The mean absolute return error was relatively contained. It suggested the model has some connection to return dynamics, not just valuation levels. They show this in their figure 3.
Okay, so not perfect on returns, but not totally disconnected either. What was the other joint estimation? Something about an Euler equation. Sounds technical.
It is a bit technical, but the idea is important. The investment Euler equation comes directly from the firm's optimization problem, how it decides the optimal investment path over time. It links current investment costs to the expected future benefits and costs.
How does that help?
The key thing is, the Euler equation doesn't directly involve asset prices, Tobin's Q. It's based more on the firm's internal calculations about the profitability of investment.
So by estimating the valuation moment jointly with this Euler equation moment, they're checking if the model fits Q just because it's fitting to market prices, which might be wrong, or if it's consistent with the underlying economics of investment decisions.
Precisely. It's a way to ground the valuation results in the fundamental investment behavior of firms, mitigating concerns that they're just matching potentially mispriced assets.
And what did they find when they did that? Did it change things?
Interestingly, no. The parameter estimates remained very consistent, and the model's fit for Tobin's Q was still excellent, as shown in their figure 4. This really strengthens the case that the valuation results are tied to the real investment side.
Okay, that's compelling. Did they push the Q sorts further? You mentioned 10 groups, deciles. Did they try dividing firms up even more finely?
They did. They ran stress tests using 20, 50, and even 100 portfolios sorted on Tobin's Q.
And what happens when you get that granular?
Well, As you'd expect, the valuation spreads get even wider in these more extreme portfolios.
Hmm.
The model still performed reasonably well overall, capturing a large part of these spreads.
Yep.
But at these very fine levels, especially with 50 or 100 portfolios, the model was sometimes statistically rejected,
Meaning?
meaning the remaining pricing errors, while maybe small in absolute terms, were statistically significant. It suggests that while the core mechanism is powerful, the relatively simple functional form for adjustment costs might not capture all the nuances driving valuation differences at that superfine level.
Okay, so it captures the big picture incredibly well, but maybe misses some fine details at the extremes. Makes sense. And the last big check you mentioned was about those nonlinear marginal costs. How important was that feature?
Very important, it turns out. They specifically compared their benchmark model, which allows the marginal cost of investment to curve upwards nonlinearly, to a simpler model that assumes standard quadratic adjustment costs.
Where the cost just increases in a straight line, essentially.
Right, where the marginal cost increases linearly. They found their benchmark model, with that nonlinearity, fit the data significantly better. Valuation errors were much smaller.
So that curvature in the cost function is actually needed to match the observed Tobin's Q levels.
It seems so. It suggests that in the real world, the costs firms face when investing probably do accelerate significantly as investment ramps up. Their Table 10 really highlights this improvement. They also found some hints that this investment technology differs across industries.
Okay, wow, we've really covered a lot of ground here, from the basic idea to the detailed tests. Let's try to boil it down. What's the single most important message, the core takeaway from this deep dive into the supply approach?
I think the core message is that this alternative perspective, looking at valuation through the lens of managers supplying assets, using readily available investment data, it works surprisingly well. It offers a really compelling and empirically quite accurate alternative to the traditional methods.
Methods that rely on those tricky long-term forecasts and discount rate guesses. So the real aha moment for someone listening is maybe realizing that a company's market value isn't just about future hopes and dreams, but it's significantly tied to the real current costs managers face when they decide to build or acquire assets.
That's a perfect way to put it. It shifts your focus. It's not just about predicting future demand, it's also about understanding the current economics of supply for those assets.
And while the model isn't perfect, maybe struggles with extreme granularity.
Right, it has limitations like any model.
Its ability to match the overall valuation levels we see in the market, primarily using current investment data, is pretty remarkable.
It really is noteworthy, especially given it doesn't lean on those highly uncertain inputs.
It does make you think differently about market efficiency, or what drives booms and busts, doesn't it, if costs of supply matter so much.
Exactly, and that leads to a really provocative thought for you, the listener, to mull over. Could shifts in the costs of supplying capital, imagine a big technological breakthrough that suddenly makes building factories way cheaper, or new environmental regulations that make it much more expensive. Could those shifts actually be leading indicators of where asset valuations are headed more broadly?
So changes in the real economy's ability or cost to produce assets might precede changes in market prices.
It's something to consider, right? How might real-world events affecting supply costs ripple through to valuations? It adds another layer to understanding market movements.
That is a fascinating thought to end on. So if people want to dig into this more, explore Q theory or this specific study.
Yeah, I definitely encourage you to look into Q theory of investment more generally. It's a rich area. And absolutely check out the original research paper by Bello, Su, and Zhang that we've been discussing. It's detailed, but it really lays out this powerful alternative perspective on valuation.
Fantastic. Well, thank you. This has been really illuminating, shedding light on a different way to think about value. Definitely given me a lot to chew on. My pleasure. Always fun to explore these ideas.
And thank you, as always, for joining us until our next deep dive.